GDP growth. We see the same sort of trend in unemployment, and we expect this comparative trend to continue into the future. Jack's going to tell you about the retail market in Spain, and specifically Madrid.
Thanks, Heidi. So to look at the Spanish retail sector, we're going to look at different transactions that we've seen in the past, specifically the stagnant market that we observed between 2009 and 2013. It's very important to realize that we bought our option to purchase in April of 2014, just before the market began to heat up. So by locking in a purchase price just before the market began to grow, this is only going to help us when we sell our asset in the coming years. Now, when we look at different cap rates between cities in Europe or in Spain, it's very important to realize that Madrid and Barcelona are leading the charge with the most healthy yields. We think that this is because investors are very confident in the growth that we're seeing within Madrid and the likelihood that this will continue in the coming years. Additionally, you can see that Madrid's current cap rate is at the lowest that it's been in the last decade, at 4%. This only strengthens our argument to try and sell our asset as fast as we can and capitalize on these hot markets that we're currently seeing. So when we look at the Spanish retail area, specifically within Madrid, you can see that there's a lot of great linkages between public transportation and hotels. There are three main streets: Serrano, Gran Via, and Fuencarral. Our asset's on Fuencarral. When you look at Serrano, you're going to have your luxury tenants like Louis Vuitton. These are going to be highest rents in the area. Second highest rents are going to be Gran Via. This area has the largest population moving through it, and it's growing very quickly. Rents are increasing in this area, and what it's doing is it's pushing tenants that are currently there out into Fuencarral who can't afford the rents in Gran Via. Now, what this is doing is it's knocking out small mom-and-pop shops on Fuencarral, ultimately making the tenants on Fuencarral healthier, with higher expected growth rates, making it a better investment for the future. When we look at Fuencarral specifically, you can see that this street has young, up-and-coming vibes. Common tenants are going to be young designers and sports retailers. Specifically, our asset is located within the middle of Fuencarral and kind of acts as an epicenter to the street. What's really unique about our asset is that of the 111 retail units that we have on this street, only 2 of these units are above 1,000 square meters. Our specific unit is 2,400 square meters, which gives us a major spatial monopoly in the area for tenants who are looking to occupy a large area or looking to expand in the near future. Now I'm going to turn it over to Nick, and he's going to talk about our business plan.
Thanks, Jack. So a significant aspect of this deal is the fact that we've already lined up 3 high-quality tenants. So we're effectively limiting our lease-up risk. And the first tenant we looked at and started negotiating with about 15 months ago is Topshop, an extremely successful UK retailer who's looking to expand for the first time in the Spanish market. They're offering the highest of the 3 tenants we looked at for rent and very low concessions. But the catch is they're not willing to guarantee the lease. They're not willing to take the risk of entering this new market and are trying to shift it off onto the property owner. And in our opinion, this is a deal breaker. And we think it's going to be a deal breaker for a lot of different potential buyers. And we think signing Topshop would introduce way too much uncertainty in terms of our hold period or selling price. So that is why they're a third choice for tenant. Looking at the next tenant is Decathlon. Another successful, it's a French retailer specializing in low-cost athletic apparel. And they are guaranteeing the lease. They're offering a little bit lower rent and higher concessions, but that guarantee, in our opinion, is going to widen that buyer pool. Also, we think they'll be very successful fitting in with the other athletic tenants that Jack mentioned that we're seeing on the street. So overall, we think they're a very solid tenant. And the third tenant is Zara. And they're the Spanish powerhouse. Over the last 5 years, they've been expanding even amongst global uncertainty and economic headwinds. They have almost 0 long-term debt. And their business plan is structured in a way that allows them to be flexible in this changing retail environment. We imagine like this affordable luxury concept a lot more resistant to e-commerce than an affordable sports retailer. So we think they're a lot more safe, and a lot more investors would be interested in Zara. But unfortunately, Zara knows this, obviously, and they drive a hard bargain. So they're offering a lot lower rent and high concessions. So essentially when weighting Zara and Decathlon, it's a balance between risk and reward. Based on our analysis, we're seeing slightly higher returns for Decathlon, compensating for the higher risk, but significantly more volatility in different states of the world for if e-commerce continues to rise and if there's another economic downturn. We imagine Decathlon struggling a lot more than a tenant like Zara. Zara's already proved themselves. So that's why we're settling for Zara, a slightly lower return, but we think It's going to offer us much more quality and a credit-worthy tenant and give us those stable returns that we're looking for. Still in the opportunistic threshold that we're looking for, but worth it, in our opinion, for our first Spanish investment. So I'm going to pass it off to Olivia, who's going to touch on a few specific things that Zara is doing to make them so successful.
Thanks, Nick. So as Nick mentioned, Zara is an absolute powerhouse in Spain and already has incredibly strong brand equity amongst Madrid locals. Zara is able to turn design concepts into products on the shelves of their stores in just a matter of 15 days, compared to an industry average of 6 months. This short lead time allows them to convert, to adjust to changing consumer preferences and understand what's going on and really make pivots to understand the market. So Zara is owned by parent company Inditex and made up 64% of their sales in 2014. Let's take a dive into Inditex's financials to understand what's going on with Zara. By looking at Inditex's EBIT growth and capital structure, we can see that Inditex has had strong operational performance and strong solvency in the long run. Zara's opened about 90 stores per year with strong economic headwinds and a challenging retail climate. In analyzing Zara's ability to afford the rent that we were asking, we said they're able to afford it almost 10 times over. Now let's take a look at the project timeline. In our analysis, we used a conservative hold period of 2 years, which we believe to be incredibly conservative. We think that we'll probably be able to sell this asset in a shorter time period once we are able to sign Zara. I'm now going to pass it off to Craig to go over company financials.
Thanks so much, Olivia. So in terms of financing the project, we had the choice between taking out debt on the acquisition or acquiring the asset completely unlevered. So our first option is through the use of the CMBS fund. And while we were able to use debt with a low effective rate and at a low LTV, ultimately the minimum 4-year hold that the term requires is incompatible with our strategy. The next source of debt we can use is from the debt fund. This is a better option than the CMBS fund because it only requires a 1-year term, which is compatible with our idea of trying to dispose of the asset within 2 years. Through taking on debt and using leverage, we will probably be able to substantially increase returns. However, if we do take on this debt, we face numerous risks, one including the flexibility of disposing the asset strategically when an opportunity presents itself. Second, we're sitting on a lot of capital unused from our fund, and through taking on leverage, our equity check will be infinitely smaller. And third, and most importantly, if we take on leverage and ultimately our leasing does fail through, our project is going to experience a dramatic decrease in returns, and we could possibly default completely. This is why we believe the best option is to go unlevered. We're able to create strategic opportunities and maximize on those opportunities, and also eliminates the downside in terms of the uncertainties of the market. So in analysis of the incremental cash flows, the project's going to cost us approximately 17.4 million euros. And because we are acquiring this asset unlevered, we're going to be providing this from our equity fund. So in order to understand the project's returns, it's imperative to understand the timing of the incremental cash flows. Here you can see when the main cash flows hit on our timeline. And so overall, to the fund, we are going to return 20% IRR with a 1.5 equity multiple over a 2-year hold. Ultimately, though, when deciding if we want to go through and fund the remaining 15 million euros in equity, it's important to only assess the incremental cash flows. We will not include the 5 million euro hard deposit because that is a sunk cost and shouldn't be included in the incremental analysis. So from that framework, the project's going to return a 40% IRR with an equity multiple of 1.9, which is a clear indicator that this will be a successful project. Using a forward NOI of 1.47 million euros and a pretty conservative cap at 4.5%, we estimate a reversion value of 32.7 million euros. And with that, I'm going to turn it over to Emmett, and he's going to talk more about the risks associated with the acquisition.
Thanks, Craig. In order to understand the risks associated with this deal, we wanted to sensitize our returns against different variables, the first being Zara's lease terms. If we were to collect 10% less from Zara in rent and give them 10% more in TI, as you can see, there would only be a marginal impact on our returns, which makes sense given that most of the cash flow is made in reversion, not from cash flow, or rather, most of the return is made from reversion, not from cash flow. Hold period and exit cap, on the other hand, tell a very different story. So why don't we take a deeper dive? Here we've sensitized the exit cap versus the hold period, our base case being in blue. Our base case was underwritten to a 2-year hold and a 4-5 exit cap, which we believe to be very conservative. We think it's highly likely that this asset trades at beneath the 4-5 exit cap based on our market research, and it's highly likely that we are able to flip it in quicker than 2 years. As you can see, in this case, there's lots of money to be made. A downside scenario is that we flip it at a 5-5 cap and hold for 2.5 years. Our returns certainly take a hit in this instance, but they're still favorable at a 24% IRR. To conclude, I'd like to bring you through some more of the risks associated with this deal and how we think that those risks are mitigated. The first being our strategy execution, the risk of geopolitical risk in Europe leading to a Spanish economic downturn. We think that our asset is relatively insulated from this risk, being that it's a high street asset with a long-term lease to a credit tenant with a guarantee from a financially sound parent company. In terms of finding a buyer when we exit the asset, well, again, we've signed a long-term lease to a credit tenant, which we think will remain attractive to institutional buyers. However, additionally, we've underwritten a very conservative cap rate, which means that we're going to have some exit pricing flexibility. If we need to offer it at a discount to get a buyer, we can do that. And then finally, perhaps the most glaring risk is securing a tenant. Negotiations may fall through, and though we think that these offers are all concrete, we've received letters of interest, we wanted to underwrite a situation, a worst-case possible scenario, or a doomsday scenario, where no tenant signs, the building's left vacant for 2 years, during which we incur annual holding costs, and then revert at a 6.5 exit cap after 3 years, which is 200 basis points above what we believe to be realistic. Even in this doomsday worst-case scenario, the project returns an 8% IRR and a 1.25 equity multiple, which, if you ask me, sounds like a pretty good doomsday. I hope we've been able to illustrate the inherent risk-reward imbalance in this deal, and moreover, I hope we've been able to convince you of the viability of the project. Our low basis, coupled with our unique opportunity to sign a credit tenant to a long-term lease, makes this deal a winner. Thank you very much for your time, and we'd now like to field some questions.
I yield to Marty. Marty builds the most beautiful skyscrapers in New York.
So you said you settled on Zara. Did you run IRR analyses on the other tenants?
We did. So here we'll show you our sensitivity.
Damn. Sorry, guys.
So here we show.
And you mentioned you had an offer at 57. You sell it with Zara's at 32. That's a pretty wide gap. So just go through the analytical.
Yeah. So the offer was not firm. In fact, they hadn't even reviewed the lease. So for all they know, the forward NOI was $3 million. Didn't feel like a substantial offer. But here we've sensitized the different tenants versus exit caps. In blue is what we've underwritten as our base case scenario for each of those tenants. And so as you can see across the board, returns are obviously higher with Decathlon and Topshop respectively, but marginally so in the base case. And again, as Nick touched on, I think that all of these options provide perhaps a bit more volatility than Zara does, so we're willing to take a bit lower of a return.
And yeah, and with regards to the offer, that's, when we acquire this asset, that's our first step, is talking to the pension fund, showing them the Topshop lease, but we just really assume that that's unlikely for a pension fund to take that kind of risk. But we would negotiate down to maybe even like $30 million, take it almost in half, and execute the deal the next day. But we just don't think it's realistic that a pension fund's going to take on a risk with no guarantee.
Do you have this matrix showing whole euro profits?
Excuse me?
Euro profits instead of just IRRs?
We do not have we do not have profits, but I think that we could get that and get back to you.
I would say we can't hire any of you guys into our Blackstone debt business because you went unlevered. And the guys on the equity side who live by promotes and stuff, and IRRs and all that. Anyway, so you didn't run this case, but intellectually I'm saying, all right, let's give this Top Shot 2 years. Did the case study say how much money they're investing in the space? How much tenant improvement that their build-out costs would be?
Yeah, TIs for Topshop is about 200 euros.
That's what we're paying as landlord, but what about maybe what the tenant? Okay.
No, I didn't say.
So a case could be Topshop's in there. I mean, the delta of rent
Yeah.
is so significant. So even without the covenant, if it's a good piece of real estate and they do really good sales, you can play through that. You may not get a 4 cap, but you can certainly get a cap rate reflecting of their sales volume.
Certainly.
So maybe a scenario to run is they're in for 2 years, that sort of craps out.
Yeah.
Then you're back in the Zaras of the world, you go for a better covenant. What's sort of that downside IRR look like? Because, you know, you are passing up all that upside, you know, going to 80% and a real windfall.
I think that's a good point.
I don't think I would have done anything differently. I don't think you need a 2-year hold. Once you sign the lease, you sort of accomplish the mission.
Yeah.
I would probably lever it a little bit, 50% or something, just to start of the fund. You want to get your fund off to a good IRR start.
Yeah.
Makes investors happy, but, you know, presentation was great. Your analysis was fantastic.
Thank you very much.
Thanks.
We appreciate
anyway. That was more of a speech by me.
So tell us how you got over the concentration of Zara in the market. Obviously, you had Zara in the other 2 markets, but in the Cornell district, if it's trying to be something different, how is that accomplishing that by bringing Zara into
Yeah.
you know, the 3rd Street?
Yeah, that's a good point. That's something that we definitely talked about. It's important to note that Zara is in Serrano and Gran Via. That's one of the things that we were thinking about while preparing this. And so we wanted to compare it to a very similar market, being Barcelona. You can see in Barcelona, if there's an opportunity in the market, they see a street growing, they're going to put a Zara there. One of the things that they do differently, and I think Olivia might want to touch on it, is that they do have like different analytics and things to control their inventory based on stores.
I think-
So Zara, each individual store does an analysis based on what products are working, which are not, and they're able to optimize that particular store into what's working in that particular market. So if you go to one Zara and then you go to a different Zara down the street, they're going to have a different inventory based on what's working at that store, which we think is great for this. Like, they're going to capture the market that is Cornell, and it will be different than the Zaras down the street.
Yeah, and I think that this shows that there's precedent for that. Additionally, Zara has multiple different lines. So one of these stores may be a Zara Home, while the other may be a Zara Kids. Yeah.
So could you explain again why you left the $5 million deposit out of the IRR analysis?
So-
Especially on your downside was 24%. If you included that.
Your fund documents don't account for it that way.
So I think that was the...
Particularly for your downside scenario, which ended up at 24%, but that did not include your initial investment.
Yeah, it's a good point. I think that around that, we're probably looking at roughly a 10 to 12% IRR in that unlikely downside scenario. Point is well taken. I think that this would be the return that we have to show when we report to investors on our quarterly reports. Again, this is using our conservative estimates. We think that it's likely that it trades at beneath the 4 cap, in which this number would go up. But yes, in terms of evaluating the project and whether or not to take the project, to compare on an apples-to-apples basis other projects that we're considering, this is what we would use. In terms of how it fits into the fund and the portfolio, I agree that this is the number we'd have to report. So it was kind of just weighing that. And
Yeah, we didn't want to essentially reject this project because overall, you know, a year and a half ago it didn't make sense, but the decision was already made, so we wanted to make sure we're, you know, having that incremental cash flow is at our return threshold for the given amount of risk, rather than saying, you know, a year and a half ago we'd make only 10%. Yeah, we shouldn't have done the $5 million, but we already did. So we really wanted to talk about, you know, what we're paying out versus what we're getting.
So you guys are kind of young to have experienced what a doomsday scenario really looks like. 1 year hiatus in your sale is not a doomsday scenario. Did you look at taking this out 5, 7, 10 years where you had to hold it because you couldn't sell it?
That's a good question. I think that the doomsday scenario, what was really doomsday about it is that all of the leases that we thought to be concrete fell through, and that it was just totally vacant for 2 years. We did not run a situation in which, you know, we don't get somebody for long after that. We felt that the 2 years was appropriate based on the conversations that we had with the large pool of investors who said that they're not going to be willing to open up another retail store in Spain for at least 2 years. So we kind of used that as our baseline scenario, figuring if Topshop, Decathlon, and Zara all fall through, the rest of the pool, the 2 years will pass, and then hopefully we'll be able to sign one of the tenants in the pool. But I think that that's a good point and something that we will definitely look into.
Yeah, and I think as we would hold this asset, and if we're really not seeing the interest or we're following up with those retailers who said, yeah, maybe in 2 years, we could start to do, a few more short-term, smaller tenants. And when Jack was touching on, so the market rents for these smaller tenants are a lot higher, but when you get a long lease, locked in for a really long time, I think the asset when it closed down was experiencing 33% turnover. So the cap rates are a lot higher, but we could just get some small amount of cash flow with temporary tenants until we felt like we could lock in a long-term tenant. So that would offset some of the holding costs.
Do you know where the corporate credit of each of these tenants trades? Did they issue public debt? If so, does that trade at 4%, 5%, 6%?
I don't believe
Grade rated?
any of them issued public debt.
The only public company is Inditex, I believe, right? Correct?
Yep,
Decathlon
that's
is
correct.
privately owned as well as Topshop. Admittedly, with the IP addresses of USA versus trying to aggregate data from Spain, it was a bit difficult. But from what we've been able to accomplish looking at public data, we couldn't find any debt offerings.
Yeah, and I don't think Zara has maybe a million in long-term debt, or $1 million euros?
Yeah, it's very, very
Versus
Very low.
10 million in equity.
Their balance sheet
They're
is
very
very,
solvent.
yeah.
I would just caution in the future of calling any brand foolproof. There's no foolproof brands.
Agreed. Yeah, that's a good point.
When you were looking at the different leases,
Yeah.
did you do effective rent analysis, and did you do analysis of rental comps? I saw a lot of bar charts and data about sales comps,
Yeah.
and it looks as if you looked at cap rate
Yeah.
comparisons, but I didn't see anything about rental analysis, rents, occupancy, rent trends for
Yeah.
different size spaces.
So right now, the margin between what Zara would be charging Zara and Topshop, because concessions are worse for Zara and better for Topshop, it would only increase that margin. Admittedly, we did not do any net effective rent calculations. And in terms of lease comps, there was a very small amount of data. In fact, most of our lease comps were for 200 square meters and below. I think maybe the biggest lease comp was for 350, so it just didn't really feel truly comparable.
Yeah, I mean, we did analyze it, and it was essentially, comparing to low credit tenants, we assumed Topshop with, no guarantee was more low credit, and then medium credit for Decathlon, and good credit for Zara. Comparing those with the lease comps for the smaller spaces, they were essentially at about a 65% discount. We thought this was reasonable, just due to the fact that you're having all those less turnover costs, less tenant improvements when you're changing tenants, and just no vacancy. So we thought it was a reasonable range, but we thought the best kind of indication of the market rents was 3 letters of interest from actual tenants, since there aren't a lot of big tenants that we're looking at the current time.
It was hard to find market data on that.
Okay, that terminates the 10 minutes.
Nice job, guys.
Thank you very
Thank
much.
you so much.
Appreciate it.
Thank you.
Please jot down any comments you may have. This is feedback that I'll love to digest later. The next thing is Clover Capital. Clover Capital.
I know, that was weird.
They've got a decision going.
Yeah.
I've heard this on